First Solar has long been one of the leaders in the solar industry, especially with their US manufacturing, but they've been a huge beneficiary of some of the tax incentives that have come out over the past couple of years, specifically the 45X tax credit that was part of the Inflation Reduction Act. The shocking thing is that half of the company's gross margin and about 2/3 of its operating income comes from this credit. And this is one of the reasons that I'm questioning the recent moves in the stock. Shares are up 48% over the past year. Over the past 5 years, they're up about 320%. But is that overdone for a company that's so reliant on tax credits? I'm going to dig into some of the numbers based on their recent quarterly report. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's look at the earnings report, and I'm going to explain what this 45X credit is. So this is their recent third quarter 2024 financial results. You can see net sales just under $1 billion. That's for the quarter. For the full year, they're now expecting $4.1 to $4.25 billion in revenue. That's actually down from their previous guidance. They're also expecting earnings of $13 to $13.50 per share in earnings, lower end of their previous guidance. But look at these gross margin numbers. About $2 billion in gross margin, so almost a 50% gross margin. That's really impressive. That's back to what First Solar was reporting in the early 2010s. That was when it was a very high margin manufacturer. Operating income right around $1.5 billion. But these numbers include the tax credit. And this first note that we see on the earnings report right here puts the credit into context. There are some ramp costs associated with ramping up their manufacturing, something they've been doing for a few years now. But there's also $1.02 to $1.05 billion in Section 45X tax credits that the company is expecting to realize in 2024. What in the world are those credits? This is the eligible component summary. This is from the Department of Energy. So there's a few different things. Solar grade polysilicon, that's not what First Solar does. PV wafers, this is what they do make, is a PV cell that is thin film, 4 cents per watt direct current. That is a direct subsidy that they get for producing those in the US. There's subsidies for polymeric backsheet. PV modules get 7 cents per watt DC. So you can see that these subsidies add up pretty quickly, especially when the production cost of a cell today is something around the neighborhood of 20 to 30 cents per watt. The other thing that First Solar reports each quarter is their expected module shipments over the long term. This is what basically their backlog is, their contracted backlog primarily. 78.3 gigawatts as of the start of this year. As of October 29th, 2024, that had fallen by 5 gigawatts to 73.3 gigawatts. So volume sold, 9 gigawatts, but they're not filling that backlog with new bookings. And that, I think, should be a really concerning thing, but obviously the market hasn't had a huge reaction to this. Potential booking opportunities, they break this down into a couple different things. 74.2 gigawatts in potential opportunities, and then mid to late stage, these are just a little bit more advanced projects. 20.9 gigawatts of opportunities. And the thing that you'll notice with First Solar is they are primarily getting backlog and opportunities in North America. They are doing that because of the subsidies that they're getting for the solar panels that they're making. I think what you're seeing in these other regions is First Solar's product is not competitive with commodity solar manufacturers in the rest of the world, whether those solar panels are coming from China, other parts of Southeast Asia. Those lower cost regions, primarily polysilicon solar panels, are winning that business. And that ultimately should be a huge concern. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. And the reason I bring this up as a concern is First Solar, I think, has gotten credit for being a leader in the industry, but is incredibly highly valued. Let's just look at the company's revenue and net income. You can see that over the past year, basically, their net income has shot higher. That is because of those tax credits that I talked about earlier. You take $1 billion in tax credits away from that, and your net income essentially dries up. This is also not a growth company. Now, there's a lot of nuance to the revenue numbers that you can see in red on this chart. The company used to be doing more project development that was higher revenue per watt that was installed. They have now more focused on just being a solar panel manufacturer. So that's why their margins are higher on each dollar of sales. So there's a little bit of nuance to that. But hard to argue that this is a high growth company. Now, they do have some manufacturing plants, especially in the US, that are going to be coming online relatively quickly. And if these subsidies stay in place, those subsidies could grow. So we could go to well over $1 billion in 45X subsidies in 2025 and 2026. But here's the question. First Solar's market cap, as I'm recording today, $22 billion, trading for about 5.6 times sales. Now, if those 45X tax credits are reduced or go away entirely, their net income almost entirely vanishes. They also become far less competitive in the United States, depending on what happens with tariffs. Now, tariffs have always been something that kind of protects US manufacturers from imports. Importers typically are able to get around those tariffs in a number of different ways. So that's why these subsidies are really important. It gives an incentive to actually produce solar panels in the US. So if those subsidies go away, now all of a sudden, First Solar's competitive position is very much diminished. Now it has to compete more on price than it does today. Sales are going to drop, margins are going to drop. I think the business deteriorates really quickly. So investors today are paying up for a company that is getting a vast majority of its margin from subsidies that are relatively new. I just don't think that's a good position, no matter what happens with the election. And we don't know from a policy perspective what is going to change over the next couple of years and what's not. But typically, these subsidies are not something that is going to drive long-term value to investors. Just look at this chart from the Solar Energy Industries Association. You can see this is when the Inflation Reduction Act passed in 2022. By early 2024, the amount of solar panel manufacturing in the US had about tripled. And most of that is coming online relatively recently. So in 2022, 2023, First Solar was signing massive deals to sell solar panels to utilities and developers in the out years, in 2026, 27, 28, when their manufacturing capacity is going to be coming online. What has happened over the past year or so? Their pace of new contract signings has slowed dramatically. Their backlog is falling, and their profitability is dependent on these subsidies, just as more capacity is coming online. And this is the problem with relying on subsidies. Everyone is going to come after them. These subsidies are not just for First Solar. These are for anybody who is building solar panel manufacturing in the US, whether that's thin film, crystalline, they're assembling modules. There is subsidies for everybody. So it's going to ultimately bring the price back down to where the market conditions were, and those subsidies are just going to be part of your normal margin. And this is what I'm ultimately worried about with First Solar, is that if you're looking at the company's financials today and you say, hey, these look really good, we're seeing a lot of growth in the out years, what you're not seeing is the potential margin deterioration as the projects that are signed now start to come online, because they're likely to be much lower margin in the future than the projects that were signed in 2022 and 2023, when there wasn't enough capacity for solar panels in the US to take advantage of these subsidies. Now there's plenty of capacity, and First Solar is no longer the only game in town. So something for investors to think about. I think this should be much more concerning, and this is a very, very high price stock given the optimism that's already priced in right now. But let me know what you think about First Solar's recent results and the subsidy reliance. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.